Do you understand different mortgage types and when it might be best to use a 15-year loan, a 30-year loan, a VA loan, how much to put down? Well, then in this episode, I'm going to take you through how to think about these different mortgage types and what might be the best for you. I find most people, when they do shop for mortgages, they don't really look at all the numbers and consider the personal, qualitative, and quantitative aspects of their situation to make the best decision for them. They might rely on their friend or family member at work. They might rely on their real estate agent, their mortgage broker to make the best decision for them. But I find if you're not taking a holistic view of your financial situation when you're making a decision on what mortgage to use for your new home, you're probably not making the best decision for you, and you're not using all relevant facts and data to inform really the best outcome for you and your family. So I wanted to take you through how I might look at this for a client and the different types of mortgages and how we can look at what these cost over different periods of time and how that might apply to your situation. Okay, so we're going to look at different mortgage types. We're going to look at 30-year conventional, a 15-year conventional, 5-year ARM or adjustable rate mortgage, a 30-year VA loan with 0% down first time and subsequent, and then a 30-year VA loan with 5% and 10% down, as well as an FHA loan. So I pulled rates, and we are going to assume the value of the house is $300,000 that we're buying. I pulled rates here in May of 2024 for these different loan types, ranging between 6 and 7% right now, depending on what loan type we're using. So when we look at what might make the most sense for us when we're buying a house, we need to look at a few things here. So we need to look at, hey, is that mortgage payment going to fit in our budget? Hopefully we're not buying a house that's so much for our income that this is really a huge consideration, but definitely a consideration. We also need to look at, I think, importantly, what is this mortgage going to cost us in fees and interest out of our pocket into the bank's pocket over the next 3 years, 5 years, 10 years, 30 years, however long we're going to own this house. And I think when we're looking at this, especially today in 2024, when interest rates are relatively high, we do need to look at it from a lens of we need to assume rates are never going to substantially go down. They might, but I think when a lot of people go and purchase a home today, they think, oh, I'll just refinance next year when rates go down. And there's no guarantee of that happening. So we do need to look at this from a lens of, okay, we need the math to work today for our income. We need this to make sense for our family. So when we look at these different loan types and we plug in the numbers, we can see quickly what that mortgage payment will be. And I'll go through some of these. So for a $300,000 home, the mortgage payment on a 30-year conventional at 6.58% is going to be $2,039 a month. Okay. If we say, hey, we want to pay this thing down quicker, we don't want to pay as much in interest, that 15-year mortgage is going to be at a rate of 5.96%, and it's going to cost another $600 a month, $700 a month. So it's going to be $2,693. The 30-year VA loan with 0% down is going to cost $2,462 a month. So we can kind of see that's definitely more than the conventional because we've got 0% down. The 5% down is going to be at $23.39 a month. The 10% down is going to be $22.16 a month. From a mortgage payment standpoint, for this specific instance, $300,000 house, we're looking at anywhere from a $2,000 to a $2,700 mortgage. We want that to be ideally like 25% or less of our income. Assuming that's true, right? The mortgage payment isn't, that monthly payment in our budget isn't the biggest concern. I'm probably, hopefully more concerned now. We're looking at what is the total cost of fees and interest of this mortgage based on how long we're going to stay in the home. So if we assume we're going to stay in this home, I think it's safe. If we think it's safe that we're going to be in this home for 5 years, a 30-year conventional mortgage is going to cost us $99,000 of interest over 5 years, fees and interest. So closing costs, everything. A 15-year mortgage is going to be $82,652. So you can already see that's a huge difference. We're shaving 17 grand off there by just going with a 15-year mortgage. If we go to the VA loans, we're going to be looking at $131,000 for a 0% down first-time user, $127,000 for a subsequent second or more VA loan user, $118,000 for a 5% down, and $111,000 for a 10% down. So we can kind of see how different that is from the conventional. I do think military veteran buyers typically default towards that VA loan because they can put 0% down because it's VA. It's kind of the default for this community. It isn't always the best. We have that funding fee. So those funding fees for the VA loan, it's going to be 2.15% for a first-time user if we're putting 0 down, 3.3% if we're using it for the second time or more, and then 5% down is going to be 1.5%, 10% down is going to be 1.25%. So when we look at that, if we can just put, I usually encourage folks, if we can just put at least 5% down, we are going to save so much in fees and interest. Most people don't think about it. They roll that cost into the loan. So it just goes into their monthly mortgage payment. But what it's doing is not only you're paying more in fees and interest, you're also increasing your debt payments, which is increasing the risk, financial risk in your life. So, we can get a really good ROI, return on investment, by putting at least 5% down on that VA loan, especially if we're using it for the second time or more. So when we draw this out a little bit more and assume we're going to hold this thing longer than 5 years, the numbers get, they get pretty big. So if we're going to hold it for 30 years, right, a 30-year conventional is going to be $410,000 in fees and interest over the cost of the life of that loan, right? A 15 year is going to be $162,000 of fees and interest. So just think about that. Let's go back up to the mortgage payment for a second. For $700 more a month, roughly, we can shave off over $200,000 of fees and interest. We can have our house paid off 15 years sooner and shave off over 200 grand of fees and interest from our pocket to the bank's pocket, right? It's going to cost us more on a monthly mortgage, but that just, especially in this high interest rate environment, that's just so powerful to be able to do that and pay less in fees and interest to the bank. Now, if we go down and look at the VA loan, we're going to see really different numbers here, mostly because of that funding fee. So over 30 years, right, we're going to pay $495,000 for a first-time user VA loan, $490,000 for a subsequent user, 0% down, and then for a 5% down, we're going to pay $463,000. So you see that huge payoff there, $490,000 versus $463,000. We're getting a lot of ROI on that because we're not paying that full funding fee up front. We're decreasing that funding fee by putting some money down. So definitely can be very, very beneficial for that home buyer to put some down. I think the longer we are in the home, if we're going to own this home for 30 years, you can definitely make the argument that funding fees and interest and all that, 5%, 10%, like it doesn't matter as much, especially if we're going to keep it and rent it out. Okay. Over the short term though, I can tell you, if we're not sure, we're buying a house, we might leave in 5 years, we might leave in 3 years, we might keep it and rent it out, we might not. The more fees and interest we pay up front, the bank is taking that straight to their profit, to their bottom line. Let's look over a 3-year period. Let's say we're a dual military household. We're leaving in 3 years. A 30-year VA loan, if we're a first-time user, our fees and interest over those 3 years is $84,000, right? For 0% down. If we can just put 5% down, it's $73,000. We're saving $11,000 over a 3-year period just by putting 5% down. If we can go with a conventional and just put 20% down, it's going to be $60,000 in fees and interest, right? So we're saving 24 grand now comparatively to that 0% down option. So we need to be thinking about fees and interest out of our pocket and into the bank's pocket over these different time periods. I think to broadly, tie a bow on all this and wrap it up, the longer you are going to stay in your house, maybe the less we need to be so sensitive about fees, interest rates. If we can make the math work, we can always refinance later, right? Like, I get it. Okay. Now we're kind of probably thinking between, okay, does a 30-year make sense? Maybe does a 15-year make sense? Those are definitely big differences. If we know we're going to stay in this for a really long time, we know we're going to keep it and rent it out. We know XYZ for sure, which I would challenge you. Nobody knows any of that for sure. But if we're going to keep that house longer, maybe these costs matter a little bit less. We still want to be cognizant of them. But for most of us that live in the real world, and we don't really know what's going to happen. We don't know if we're going to leave in 3 years and not want to, be in this house anymore. We don't know if we're going to keep it and rent it out. We hate being landlords. We're going to move on from this thing. Fees and interest are super, super, super important. We're going to be either paying 90 grand to the bank or we're going to be paying 60 grand to the bank. Like, these are important decisions that you need to be aware of when you're buying a house. So the shorter that time period, the more we need to really be careful about how much we're putting down. Are we using a VA loan? Are we doing a conventional? Are we doing an adjustable rate? Do we think maybe a 5-year adjustable rate makes sense? I would say with high interest rates right now, maybe not. This was a strategy that was more appealing back when interest rates were lower. But we need to be thinking about these things in the context of how much are we paying to the bank and over what time period. So I hope that this was helpful. A helpful look at mortgages, different mortgage types, how we should be thinking about 15 versus 30, VA loan versus not VA loan. Do we put 5% down? How do we kind of think about this in the context of how long are we going to be in the house? What's our budget? And what is our appetite to pay fees and interest to the bank? Let me know if you have any questions. Thank you for being here, and we'll see you next week. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com, where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back next week with some more content to help you on your journey to financial freedom. See you then. This is a friendly reminder that the Bluff Finance Podcast is general and educational in nature and does not constitute tax, investment, legal, or financial advice with respect to any particular individual or taxpayer. Please consult with your own tax, legal, financial, and other advisors regarding your own unique situation.